This topic is about portfolio of many risky assets. From Learning Module, Portfolio Risk and Return, Part 1. Portfolio variance depends on variances of each asset and covariances between assets. Portfolio variance does not depend on expected returns. Expected return affects the portfolio's return, not its risk. Standard deviation matters because each asset's variance is part of the formula. Covariance matters even more as number of assets grows. For large portfolios, covariance accounts for almost all the risk. The weight on the average individual assets variance is exactly 1 divided by n. When n equals 10, the weight is 1 divided by 10 equals 10%. When n equals 100, the weight is 1 divided by 100 equals 1%. As n grows larger, 1 divided by n becomes smaller and approaches 0. In the portfolio variance formula, the individual risk, the variance, of each stock is divided by n. When n is 100, that individual risk is cut into 100 tiny pieces, making its contribution to the total portfolio risk gradually become negligible. The formula also includes the average covariance, how stocks move together. This part of the formula does not get divided by n in the same way. Instead, it approaches the average covariance as n increases. Because the individual parts shrink towards 0 and the group part remains steady, the covariance among the assets accounts for almost all of the portfolio's risk in large portfolios. This topic is about the power of diversification. For zero standard deviation, the portfolio return must be exactly the same in every scenario. Assets X and Y move in exactly opposite directions across scenarios. Perfect negative relationship. They perfectly cancel each other's variation, which results in zero portfolio risk. The other pairs do not cancel perfectly, so their portfolio returns vary across scenarios. For equally weighted two-asset portfolio, portfolio return in each state equals 0.5 times return of first asset plus 0.5 times return of second asset. Then calculate the standard deviation of the three portfolio returns. Highest standard deviation is portfolio J and K. J and K produce the largest spread in portfolio returns, 9%, 0%, 0%. J and L produce exactly the same portfolio return, 3% in every state, 0 standard deviation. K and L produce a moderate spread, 3%, 0%, 6%. The portfolio with the biggest variation in returns across scenarios has the highest standard deviation. Portfolio standard deviation formula includes a covariance term. Lower correlation makes the covariance term smaller, which results in lower portfolio variance, leads to lower standard deviation, or volatility. Higher correlation keeps the term larger, which results in less risk reduction. The key benefit of diversification is lower correlation. Lower correlation reduces portfolio risk more than high correlation. Expected return is unaffected by correlation, just weighted average. Sharpe ratio is not guaranteed. When assets have equal weights and equal volatility, the lowest possible risk occurs at the lowest possible correlation. Correlation is the only factor that can still be changed to reduce risk further once weights and individual volatilities are fixed. Decreasing correlation gives the biggest and most direct reduction in portfolio standard deviation. This topic is about efficient frontier, investment opportunity set, and minimum variance portfolios. The efficient frontier is the upper half of the minimum variance frontier of risky assets only. Portfolios that mix the risk-free asset with risky assets lie on the capital allocation line, not on the efficient frontier. Efficient frontier is the best portfolio made only from risky assets. Capital allocation line is the straight line formed by combining the risk-free asset with the optimal risky portfolio, tangent point on the efficient frontier. Option B mixes up the efficient frontier with the capital allocation line. Draw all possible portfolios of risky assets, you get the minimum variance frontier. The leftmost point on that frontier is the global minimum variance portfolio. It has the smallest standard deviation of any risky asset portfolio. Global minimum variance portfolio is on the minimum variance frontier, not below it. It is the lowest risk point possible using only risky assets. The efficient frontier starts at this point and goes upward. Plot all possible risky asset portfolios, you get the minimum variance frontier. A curve. The lowest point on that curve is the global minimum variance portfolio. Everything above the global minimum variance portfolio, the upper half, is the efficient frontier. Every portfolio on the efficient frontier has higher expected return for the same risk, or lower risk for the same return, than any portfolio below the global minimum variance frontier portfolio. Therefore, the efficient frontier dominates all portfolios below the global minimum variance frontier portfolio. Portfolios below the global minimum variance frontier are inefficient. You can always do better by moving up to the efficient frontier. The capital allocation line is something different. It includes the risk-free asset. The global minimum variance portfolio is the portfolio on the minimum variance frontier that has the smallest standard deviation. Look at the standard deviations. X and Y both have 18%. Z has 22%. X and Y have the same risk, but Y has a higher expected return, 6% versus 4%. On the minimum variance frontier, for any given level of risk, there is only one portfolio, the one with the highest possible return. Portfolio X has the same risk as Y, but lower return, so it lies inside the frontier, inefficient. Portfolio Y lies on the frontier and has the lowest risk among the three portfolios. Therefore, Portfolio Y is most likely the global minimum variance portfolio. The global minimum variance portfolio is the leftmost point on the minimum variance frontier of risky assets. A portfolio with the same risk but lower return cannot be on the frontier. Z has higher risk, so it cannot be the GMVP. This topic is about efficient frontier, a risk-free asset, and many risky assets. Both investors face the same set of risky assets. They both select the same optimal risky portfolio, the tangency point on the efficient frontier. They then combine that single optimal risky portfolio with the risk-free asset. Different risk aversion only changes how much each investor allocates to the risky portfolio versus the risk-free asset. All possible combinations of the risk-free asset and the optimal risky portfolio lie on the same straight line, the capital allocation line. Therefore, both investors' optimal complete portfolios are on the same capital allocation line, just at different points. The capital allocation line is identical for all investors because the opportunity set is the same. Only the position on the capital allocation line changes with risk aversion. More risk-averse investors stay closer to the risk-free asset. The efficient frontier itself contains only risky asset portfolios. It does not include the risk-free asset. The equation of the capital allocation line is expected return equals risk-free rate plus slope of capital allocation line times portfolio standard deviation. The slope of capital allocation line is exactly the extra return above the risk-free rate divided by the standard deviation of the optimal risky portfolio. The dominant capital allocation line is the steepest line from the risk-free rate that touches the efficient frontier. Its slope is the sharpe ratio of the optimal risky portfolio. Risk aversion changes only where the investor sits on the capital allocation line. It does not change the slope. Correlation with the risk-free asset is always zero. All investors choose the same optimal risky portfolio, the tangency point on the efficient frontier. The capital allocation line shows all combinations of the risk-free asset and this optimal risky portfolio. To get higher return and higher risk than the optimal risky portfolio, the investor borrows money at the risk-free rate and invests more than 100% in the optimal risky portfolio. Borrowing moves the investor beyond the optimal risky portfolio along the same capital allocation line to the right. Allocating to the risk-free asset moves left, lower risk and return. The investor does not switch to a different risky portfolio. The optimal risky portfolio stays the same for everyone. Plot all risky asset portfolios, you get the minimum variance frontier. The upper half of that frontier is the efficient frontier. Draw straight lines from the risk-free rate, 2%, to every point on the efficient frontier. Only one line touches the frontier at exactly one point and has the steepest slope. That point of tangency is called the optimal risky portfolio. The optimal risky portfolio is the single risky portfolio that maximizes the slope of the capital allocation line. Every investor uses this same portfolio. They only differ in how much they mix it with the risk-free asset. The global minimum variance portfolio is the leftmost point, lowest risk, not the steepest slope point. This topic is about efficient frontier, optimal investor portfolio. Every investor, regardless of their personality, looks at the market and identifies the same optimal risky portfolio and the same capital allocation line. Once the line is set, the investor chooses where to sit on it. This choice is determined entirely by their degree of risk aversion. A highly risk-averse investor will stay closer to the risk-free asset to avoid volatility. A less risk-averse investor will put more money into the risky portfolio to chase higher returns. Best risky mix is separated from the investor's feelings. Everyone agrees on what the best risky basket is. They only disagree on how much of it they can stomach owning. In technical terms, the proportion is determined by the point where the capital allocation line is tangent to the investor's indifference curve. Market portfolio or the global minimum variance portfolio are the characteristics of the available investments, not the individual investor. They stay the same even if the investor changes their mind about risk. Every investor, regardless of their risk aversion, identifies the same optimal risky portfolio and the same capital allocation line. This is the best deal available in the market. Once the line is set, you decide where to sit on it based on your risk aversion. The more risk-averse investor wants to avoid losses and volatility. To do this, they put more money into the risk-free asset like cash and less into the risky portfolio. Because they have higher weight in the safe asset, which has zero risk, their total portfolio standard deviation or volatility will be lower than that of the aggressive investor. Standard deviation is the mathematical measure of risk. A more risk-averse person, by definition, wants less of it. Option A. Sharpe ratio is the slope. Because they are on the same capital allocation line, they are actually getting the same return per unit of risk. The deal doesn't get better or worse. They just choose a different amount of that deal. Option C. They cannot have the same weight. If they had the same weight in risky assets, they would have the same risk, meaning they would have the same risk aversion, which contradicts the question. The two-fund separation theorem says, investment decision, choosing the optimal risky portfolio, is the same for all investors. It's the tangency point between the risk-free rate and the efficient frontier. Financing decision, like how much to put in risk-free versus risky, is personal. Each investor chooses a point on the capital allocation line based on their own risk preferences. The investor's risk preferences are shown by their indifference curves. The optimal point for that investor is where their highest possible indifference curve just touches or is tangent to the capital allocation line. This tangency determines their exact mix of risk-free asset and optimal risky portfolio. Utility function is the formula, but the indifference curve is what we see on the graph. The question asks what the capital allocation line is tangent to. That is the indifference curve. The efficient frontier is for risky assets only, not where the capital allocation line meets investor preferences. Utility function is the mathematical tool, but indifference curve is the graphical representation used in the curriculum.